Hey, it is Troy Stavros with Cornerstone Realty Associates here in Knoxville, and the March numbers are in for the East Tennessee housing market. A little bit late this month, but wanted to make sure you got this, and there's a lot to unpack. So closings are down across most of the region, but pending data is telling a different story. And if you're only looking at the closing numbers, you're going to miss what's actually happening. So we've also got oil at $100 a barrel, inflation running hot again, and a geopolitical situation that could swing mortgage rates in either direction over the next 60 days. So let's get into it. First, the regional overview. Starting with the big picture across our 6-county region that we serve, that's Knox County, Blount, Anderson, Loudon, Roane, and Sevier, we recorded 1,104 total closed transactions in March. 4 of the 6 counties saw year-over-year declines in closings, but here's where it gets interesting. Regional pending sales came in at 1,837 contracts. That's up just 0.9% year-over-year. Now, that's not a huge number, but it is positive. And when you dig into where that growth is coming from, the story gets a lot more encouraging, at least for the parts of the region that we're dealing with. We'll get to that county by county in just a second. So the 30-year fixed mortgage rate as of mid-April sits at 6.33%. That's come down a bit from the peaks we saw last year, but it's still a significant headwind. It keeps buyers on the sidelines, and it's keeping would-be sellers locked into their current low-rate mortgages as well. And it's the single biggest factor shaping what we're seeing in these numbers. So, the Knox County data. All right, let's look where we always start, and that's with Knox County. This is the biggest market in the region by far, and it sets the tone for everything else. Knox posted 550 closings in March, which was down 16.7% year over year. Now, that's the steepest decline among the core counties, and I know that number looks alarming, but stay with me. The forward-looking data paints a completely different picture. So, forward-looking data is pending sales, and pending sales in Knox County rose 10.5% to 789 contracts. That is the strongest pending performance in the region by both volume and growth. Active listings climbed 12.5% to 1,519 listings, but even with that inventory build, the absorption rate held at just 2.42 months worth of inventory. That is the tightest in the entire 6-county area that we serve. Median days on the market was just 30 days, and the sold to original list price ratio came in at 96.1%, which was the highest in the region, and the sold to final list ratio was 98.3%. So what does all that mean? It means well-priced homes in Knox County are still moving, and they're moving quickly with minimal price concession. The gap between the closing decline and the pending surge is almost certainly a timing issue. Rate volatility late last year and early this year delayed some contracts from getting to the closing table in March, but those deals are in the pipeline now. So expect Knox closing numbers to bounce back in April and May as those pendings convert to sales. Okay, let's look at Blount County. Next up, Blount County had 169 closings, down 6.6% year over year. That's a moderate decline, right in line with the broader trend. Pending sales ticked up 3.9% to 186 contracts, and active inventory was essentially flat at 454 listings, down just 1.5%. The absorption rate here is 2.63 months, and the median days on the market is 32. Those numbers are almost identical to Knox, and that's not a coincidence. Blount continues to function as an extension of the Knoxville core market, not as a secondary outlier. The sold to original list ratio was 95.5%, sold to final list was 98.1%. One thing I want to highlight about Blount is the available inventory stability. This is one of the only 3 counties where active listings did not increase year over year. That tells us new listing activity is roughly matching absorption, which is keeping the supply-demand balance steady. Blount is in a healthy spot right now, so that is good. Let's look at Anderson County. Anderson County had 76 closings, down 7.3% year over year, but pending sales jumped 15.7% to 96 contracts, and that's the second strongest pending growth rate in the region, behind only Loudon County. Now, active inventory did climb 18.9% to 201 listings. That's the sharpest inventory increase among the core counties, and it pushed the absorption rate up to 2.66 months. Median days on the market was 33 days, and the pricing ratios were 95.4% of original list or 97.5% of final list, right in line with the regional band. Anderson's story this month is expanding supply, meeting strengthening demand. If pending conversion rates hold, that additional supply is healthy, and it means more sellers are feeling confident enough to list heading into spring. But if pending activity plateaus while listings keep accumulating, we'll see that absorption rate drift towards 3 months, and pricing pressure could follow. So that's one to watch. Let's look at Loudon County. Loudon County had 90 closings, perfectly flat year over year, 0% change. That's actually the most stable closing performance in the region. But the headline here is pending sales, up 35.1% to 127 contracts. That's the highest year-over-year pending growth of any county in the data set, and it's not even close. Now, before we get too excited, Loudon's market structure is fundamentally different from the urban core. The absorption rate is 3.62 months. Median days on the market is 64. That's more than double what we're seeing in Knox County. And the sold to original list price ratio of 94.4% tells us buyers are negotiating meaningful discounts off the initial asking price. So what's driving that 35% pending surge? It could be accumulated price adjustments finally bringing buyers to the table. It could be buyer migration from the increasingly competitive Knox and Blount corridor, where people are getting priced out and looking further out. Either way, it's an encouraging sign, but sellers in Loudon need to price realistically from day one. The market will find value here, but it just takes twice as long to do it as it does in Knox County. Okay, Roane County. Roane County delivered the strongest closing performance in the region this month. 83 transactions, up 38.3 percentage points over last year. That's a significant acceleration. Pending sales dipped modestly, down 4.5% to 85 contracts. Active inventory sat at 454 listings, down 1.5%. Absorption rate was at 3.25 months. Median days on the market was 49. Pricing ratios, 94% of the original list and 97.1% of the final list. Second weakest in the region, above only Sevier County. Now, that 38% closing surge likely reflects a catch-up dynamic. Contracts written during earlier months when rates briefly dipped are now settling in, and it probably benefits from a favorable year-over-year comparison from the year earlier. The slight decline in pending activity suggests the next few months may moderate from this pace, but the overall trajectory is positive and Roane is moving in the right direction. Let's look at Sevier County. All right, I need to spend a little more time here because this market stands completely apart from the rest of the region. And if you've watched my previous videos, this isn't something new. Closings fell 24% year over year to just 136 transactions. Pending sales dropped nearly 30% to 270 contracts. Those are by far the steepest declines in the data set on both measures. 24% down in closings, 30% down in pending sales. Active inventory climbed 13.6% to 1,844 listings, producing an absorption rate of 9.08 months. 9 months of supply. That is more than triple what we're seeing in Knox County, and it's firmly in a buyer's market territory by any definition. Median days on the market hit 70 days, and the sold to original list price ratio was 92.3%. meaning the average closed transaction settled at nearly an 8% discount to the initial asking price. And the sold to final list ratio of 96% tells us that even after sellers cut their price, buyers are negotiating additional concessions at the offer table. Sevier's challenges are structural. The county's heavy exposure to short-term rental and vacation properties make it acutely sensitive to shifts in investor sentiment, changes in short-term rental regulation, and fluctuations in tourism cash flows. With oil over $100 and discretionary travel budgets getting squeezed by the energy-driven inflation spike, the demand side of this market faces headwinds that the other 5 counties simply do not. And the 30% decline in pending sales is particularly concerning because it tells us the closing weakness isn't going away. It's going to persist through at least May. And if you're a seller in Sevier County and you need to transact, you need to be pricing aggressively and you need to be prepared for an extended timeline. Okay, the core versus the outer ring. So zooming out for a second, the big theme this month is a market operating at 2 distinct speeds. You have the urban and the near suburban core, Knox, Blount, and Anderson County. Those remain relatively tight. Absorption rates are below 3 months. Days on the market in the low 30s. Homes are moving, price concessions are modest. Then you have the outer ring, Loudon County, Roane County, and especially Sevier. These are materially looser, longer timelines, weaker pricing, and more negotiation. And that divergence is widening, not narrowing. Where your property sits geographically is driving the conversation around pricing strategy, listing timelines, and negotiating leverage more than almost any other factor right now. Let's jump over and look at the macro environment. Now, the macro picture is important because it matters, and honestly, it matters more right now than it has in a while. Crude oil is at $100.80 a barrel. That price reflects a significant geopolitical risk premium tied to the situation with Iran. President Trump recently indicated a reluctance to extend the current ceasefire, and traders have responded by adding what they're calling a war risk premium to the price. Markets are reacting to potential disruptions in the Strait of Hormuz, where roughly 20% of global oil flows, and analysts are saying that if diplomatic talks fail, Brent oil could quickly move towards $110 a barrel. If a ceasefire extension is reached, prices could ease back toward the low 90s. This feeds directly into the inflation numbers. March CPI came in at 3.3% year over year, with a 0.9% monthly increase driven almost entirely by a 21.2% surge in gasoline prices. The energy index was up 12.5% annually. Core CPI, stripping out food and energy, held at 2.6%, which is more reassuring. The underlying inflation pulse hasn't re-accelerated broadly, but 3.3% headline is what consumers feel at the pump and in their utility bills, and it's what constrains the Fed's ability to cut rates. And here's the part that hits housing directly. Real wages are losing ground. Real average weekly earnings declined nearly 1% in March as inflation outpaced wage growth. For a market that's already stretched on affordability, falling real wages are a direct drag on purchasing power. That's especially relevant for first-time home buyers and for markets like Anderson and Roane, where the buyer pool skews towards middle-income households. So, what's the forward-looking outlook? Where does that leave us heading into the spring market? For Knox, Blount, and Anderson, the core, I'm cautiously optimistic. Absorption rates below 3 months, days on the market in the low 30s, and a strong pending pipeline all point to continued activity. The closing declines in March look more like a timing blip than a fundamental demand shift, and the pending data backs that up. If you're selling in these markets and you're priced right, you should still expect competitive interest. But the days of routine multiple offer situations above list price are largely behind us. The sold to list price ratios in the mid 95-96% range tell us the market is finding fair value but not paying premiums. For Loudon and Roane, it's a story of gradual normalization. These are balanced markets trending towards buyer-friendly. Sellers need to plan for longer timelines and more negotiation. That 35% pending spike in Loudon is a genuine bright spot. If it sustains, it could signal a turning point. Sevier County requires a complete different conversation. 9 months of supply, 70-day marketing times, and worst pricing metrics in the region. Expensive oil, discretionary budgets, elevated rates. This disproportionately hit Sevier's buyer profile. Until one or more of those macro factors eases, Sevier is going to continue to underperform. Okay, the wild card, and I want to leave you with this because it's the single biggest variable on the board right now. The geopolitical situation with Iran is in a very real sense the thing that could move our local housing market more than anything else over the next 60 days. A ceasefire extension pulls oil back to the low 90s. That eases inflation expectations. That potentially gives the Fed room to signal rate cuts later this year. And a rate cut signal, even just the signal, would be meaningfully positive for housing demand across the region. On the other hand, if diplomatic talks collapse, oil pushes towards $110 or higher, gasoline spikes again, mortgage rates drift back towards 7%, and the modest closing declines we saw in March could turn into something more sustained. It's not something any of us can control, but it is the macro factor I'm watching most closely right now. And if you're making decisions about listing, buying, or pricing in the next couple of months, it should be on your radar too. Okay, well that's it for March. I'll be back in a couple weeks with the April numbers as soon as they drop. And if you found this helpful, I'd appreciate if you liked this video, subscribed, and all the good stuff. And I will see you next month.